I'm the co-chair of the CleanTech Challenge. I want to welcome you guys to this amazing co-space here under the bridge. Today we have an event. It's being framed. It's an investor panel discussion framed around the topic of financing the entrepreneurial idea. Some logistical issues before we kick start. If anybody has to go to the bathroom, right over there on the right hand side. The way that we're going to run it today, we're going to have a couple introductory remarks, then we're going to follow by the investor panel discussion, which will be moderated. Nonetheless, there will be some time for you guys to ask questions, so feel free to participate. This is about you guys getting engaged, so feel free to ask any questions that you guys might have throughout the discussion. With that said, the event is hosted by Sustainable Bridges, which James will talk a little bit about in just a moment. And it's sponsored by the CleanTech Challenge and the London Business School Private Equity and Venture Capital Club. The CleanTech Challenge, for those of you guys who are not familiar, it's a global business plan competition open for students who are interested in CleanTech. It's been running since 2009 and is run both by the London Business School and UCL. Runs from January till April of each year. So right now we're in the process of finalizing this year's competition. So do stay tuned if you want to kind of learn about who wins the competition this year. In case you guys have any questions about the CleanTech Challenge or want to get involved, please reach out to me, or feel free to go into cleantechnologychallenge.com. The London Business School Private Equity Venture Capital Club is one of the largest kind of student-led clubs in both private equity and venture capital. They have over 6,000 registered people globally, so quite strong network of financiers. And obviously this is hosted by Sustainable Bridges. I'll let James introduce what they do here, in case any of you have any questions about what they do with the co-space here. That said, before I hand it over, I want to give great thanks for James and his team, because obviously without them, we wouldn't be able to host this amazing event today. So thanks a lot.
So how many people here are a student? How many people are thinking or have started their own business? So about 5.5 years ago, we set up Sustainable Ventures. And at that point, there was 3 of us squatting in someone's spare meeting room. And we had a couple of business plans on the table. Since then, we've built 7 businesses from scratch as founders. First one we founded was called E-Car Club, which was the UK's first entirely electric vehicle car sharing model. Went through various funding rounds from turning that business plan. We raised some grant funding, we raised some angel funding, we did the first FCA regulated crowdfunding round. We took corporate investment from Centrica, and then we exited the company summer before last to Europcar, creating the world's first crowdfunding exit. That's about the life cycle of a startup you can go through. We've done that several times, the only exit, and as part of that journey we needed and had demands, as many companies do. Apart from the slight difference of one of our second or third companies called PowerVault, which you may have seen as you walk through or heard of before, doing energy storage. And for that we needed somewhere we could put batteries, 5 tons of batteries. Not easy to find in central London. With a lot of searching, we struggled to find anywhere in central London, which is a difficult task in its own right. Not less trying to find somewhere in a central location of low cost where you can put workshops. We ended up finding this space, and we decided to set it up as a community interest company called Sustainable Bridges. And we ended up moving 10 staff into here. And then we thought, well, we've got lots of room, why don't we offer it out to some of our friends? And within a year, it filled up and was full. And it's varied, that was 2 years ago. And for the last year, it's hovered sort of 90 to 100% of companies have grown, outgrown us, downsized, and changed. It's now the highest concentration of sustainably focused startups in the UK. There's been a huge amount of growth around this, and some of the people that have brought their own businesses here alongside of the businesses that we've founded. Pitt, for example. Pitt, I'll use you as an example. Pitt moved in when there was, 4 of you? You've grown to 20 odd now, raised significant funding, and no doubt will continue to scale, and is a great example of what you can do. And if you want to chat to anyone that's gone through it, it's a good guy to chat to, and there are several the other team members in here. Alongside of that growth, we, as I said, have been full for about a year, so we decided to try and find more space, and we've been working on that quite significantly for the last year, so that we can have more people in the community and build up more partnerships and get great levels of learning between all of the 15 to 20 startups that are in here. So we're about to open a new space the other side of London Bridge, which will be called Sustainable Bankside, and that will be about 3 times the size of this. So we'll have both of those open, and need to be corrected if I get it wrong, but those combined should be the largest in Europe. And there's going to be huge capacity for additional startups, and we're trying to accumulate the huge amount that are spread all over London. There are literally thousands of environmentally focused businesses, and actually by coming together in a space like this or any other, it means you can learn very, very quickly off of the people that are in here, just accidentally over a coffee, or when we do more things of a structured nature like this. The last part I'll just mention is we're now trying to take some of the learnings that we built up, building our own businesses as entrepreneurs, and apply some of that machinery we built up to others. So much in the same way as you may have come across accelerators, we've just decided to design one in exactly the same way that we've done things for ourselves. So for example, PowerVault, one of our businesses, was about 4 people 18 months ago. It's now 20 something, it's raised about 2.5 million, and we'll raise multiples of that this year and scale the market. We want to try and do that for others from an early stage and help out. And we'll be doing that alongside lots of other investors in partnership. So I would like to sort of end on that note and say, well, hopefully this will be a useful evening for everyone. It's been extremely well organised by our friends at the CleanTech Challenge. And I would like to hand over to the esteemed panel and a colleague of mine, Peter Shortt, who has far more experience in investing than I do. 30 years or something?
Something like that.
Yeah.
That's all it means, James. It doesn't mean that really good.
And Peter's heading up as Chief Investment Officer at our new Accelerator fund.
Thank you. First of all, it's a real pleasure to be here tonight. I haven't done an event like this in some time, having spent the last few years of my career before sort of retiring, working in government and in primarily in the Ministry of Defence, where I did a few privatisations and asset sales. Before that, I was a director with an organisation called Shareholder Executive, which some of you might have come across. We were the people who, for good or ill, rescued the banks, sold off British Energy, set up Green Investment Bank and British Business Bank, and I sort of had a tangential involvement in some of those activities. Before that, and it's the sort of reason I'm here tonight, I ran the investment activity at Carbon Trust, where I worked with my friend and colleague Andrew Wordsworth, who's sort of the MD of our little group of ventures. And I've sort of formally and informally been helping Andrew and James and Chris develop the portfolio of activities here over the last few years. So it's really interesting to be here, and as I said to somebody earlier on, it's either this or a golf course, and this is a lot more fun. Now, structure tonight, I understand that there is a sort of a CleanTech edge and focus to some of you guys' interests, and we've got the CleanTech group from LBS involved in that. I suspect in a number of the answers to questions which I haven't quite made up yet, so the august panel doesn't know what I'm going to ask because I haven't really thought of it myself. But we'll probably get a bit of a clean tech or sustainability focus. But I think it would be useful if we could keep it a little wider than that, so that there's not a particularly specific environmental or circular economy or whatever the current buzz phrase focus on the discussion is. In terms of the format, I'll ask some fairly open questions to colleagues. If you feel sort of an overwhelming urge to interrupt or make a view, stick your hand up. I'll point out to somebody, please just give your name and background and a particular focus. What I do intend is that we've got some space for a Q&A at the end. But I think for the first half an hour, 35 minutes, panel focused with some questions. So if that works for everybody, what I'll ask is if colleagues on the panel just sort of say a few words about themselves, and then I will think of a question to ask. Lucy, do you want to kick off?
Hi, I'm Lucy Rands. I'm obviously quite early on in my career. I hope it's obvious. I've got a background in engineering and material science, and I'm an alumni of the Climate Kick program, which I think some of you might be familiar with here. I joined ETS Partners a year ago, which is around today, and we invest in sustainable technology companies. We are typical venture capital rather than seed, so we tend to get involved at a stage where a company already has quite a lot of commercial traction. But a lot of these investment philosophies will be similar all the way through. So I hope I can answer your questions and perhaps win some advice as well.
Okay, so I'm Charlotte Croffie. I'm Director for Entrepreneurship at UCL. And in terms of the role and the remit I have, it's to work with students, it's to work with early career researchers and staff, looking at business opportunities, how you translate that, whether it's for commercial gain or whether it's a social enterprise that has impact. I also work across the institution, so UCL is we call it a comprehensive university, which means it's big. And so we have a number of different areas, from engineering, built environment, we cover sustainability, we cover arts, humanities, a full gambit. And I work across the university to ensure that we bring our academic knowledge and skills and professional skills to bear in terms of how we support different ecosystems.
Hi, I'm Alastair Stewart, so I work for IP Group. We're the leading or the largest University UK IP commercialisation company. We're about £1 billion in market cap, and I have the joys of working with over 100 companies now. We have a model actually where we are typically the largest minority co-investor. So we actually work with our companies to find additional financing as they grow, and that's what our team is responsible for. So we work with a wide variety of co-investors, being family offices or our shareholders or asset managers or high net worths, and we have the fun of talking about very complex science to generalist investors and bridging that gap.
My name is Iliev. I'm a founder of EcoMachines Ventures. So I'm a serial entrepreneur by background, cursed with an economist education, but doubly cursed with engineer parents, so here I am. But basically we invest in companies broadly in the environmental and industrial high-tech space. We invest from seed through to Series A, B, but we tend to be quite hands-on in the sort of work that we do, and we try to work alongside corporates as we grow the companies. So.
Thanks. My name is Alex Pitt. Thank you, Nicholas, James and Peter for having me. It's a real privilege. So I started a couple of years ago an investment firm called Mustard Seed with a great friend of mine from university days. We'd initially wanted to start our own company, but we didn't have any good ideas, so we thought we'll find others. So we literally showed up at it was LBS in 2014 with a one-page flyer saying we had £20,000 to invest, and 200 people showed up, and that's where it all started, which we thought was a bit strange, but that many people came. So we now have a company. We make investments in businesses solving social and environmental challenges, what we call lockstep models, where there's a correlated link between the commercial outcome and the social or environmental outcome. And we've made 13 investments now. Capital is sadly no longer our own. We've spent all our money on the company and paying salaries for our team. The capital comes from a growing network of investors who get involved either as members and they pay an annual membership fee, or as fund investors. We have a small EIS fund.
Peter Bachmann, I'm from SEP, or Scottish Equity Partners, and despite the name, they employ non-Scots. And we have offices here, which is a common question. But we're a fund manager. We manage about 1.1 billion sterling on behalf of pension funds and other institutional investors. We invest into three broad areas: tech, healthcare, and energy. On the tech side, you've probably come across one of our companies, which was quite a success recently, Skyscanner. We invested in that as a venture deal from 2007 and sold it for about 1.4 billion sterling in December last year. I manage our environmental capital fund, which invests into energy-related infrastructure projects and companies. So I guess I cover a bit of both project and company investing.
Brilliant, thank you. I think we've got a great panel tonight, and the opportunity to sort of listen to what everybody's saying sort of help me frame an opening question, which I'll sort of throw out. The name of the title of tonight's event is Financing the Entrepreneurial Idea. So there's sort of two components to that, if you like. There's the financing bit, and there's the entrepreneurial bit. And I think one of the things that I'm most interested in is understanding why people invest and what it is they look for and what the drivers of the investment are. And can I kick off you? Because you do something slightly different, which is a sort of a slightly hybrid financial, non-financial investment strategy. I mean, is that right? Is that a fair characterization of what you do?
Well, we call it lockstep models, which is basically a fairly overly fancy way of saying we look for good business models, solving big global challenges. So for us, it would never be around a local issue. It would be a big problem like food waste, for example. So we've backed 3 businesses reducing food waste. Depends which report you read, but something like $1 trillion of food is wasted globally in different parts of the supply chain, in stores, in farms, in people's homes. And we think you can make money, make a strong return for investors, and reduce that food waste materially. So that's the kind of business model that we look for. And then of course we look for visionary, committed, passionate founders. We get to know the founders very well before we invest. And that's a really important part of our process as well.
Yeah. I mean, in terms of that presentation, when you're looking at an early stage business, Lucia, what is it you look for in the business plan and in the presentation?
Well, for me, this might sound obvious, but a clear articulation of how you're going to make money and why people are going to pay for it. Because even at the stage I see companies where they've got a couple of million in revenue and they're obviously got something that's working for someone, I can sometimes sit in a meeting for an hour and come out not knowing what to do. And I think some people are so close to what they do that they forget to kind of take a step back and say, this is what we do, this is why it's a good product or a good idea, and this is how we're going to make money from it, and actually being able to articulate that and understand it early on, I think is really key.
I'd be interested to know in environmental or technology-based businesses, are people looking, is it a business model, is it the people, or is it the technology, or is it the IP? Yeah, please. Because if you're clearly from a university background, there's an implication that university deals are based on people being clever. Didn't say it was true, just say it was an implication.
Partly. I'm going to take it back a stage. In terms of what we're looking for, it's not when you make the big money. It's when you first start, you have to be very clear again about the articulation of the idea. But you need to be able to understand what it is that you're trying to achieve. Investors, and we do invest in some of our startups, and we are the ones who support them in terms of underwriting the risk, if you like. And what we look at is somebody who comes, has an understanding of what it is they're trying to do. So what is the problem they're trying to fix? How are they trying to fix it? What way, how? And who it is that they want to work with. And the investment part of it is key, because I believe, and this is what we say to the people that come through and use our services, when you start thinking about your idea and what it is that the problem you're seeking to solve, you need to understand how you're going to make that happen. And a lot of that is based not just on the idea, but it's how you make it sustainable. So how do you get the finances in order to start what it is that you're trying to start? And to be able to convince somebody, you have to have not just a compelling story, but you have to be able to convince them that what you're doing is different from what everybody else is doing, so that they can put their money into what is in effect an idea you have, and something that will build and scale up and eventually make money for them. So just to wrap it up, in terms of from the university perspective, the idea idea is a good thing, but the idea alone is not enough. It's the individuals behind it, it's how you articulate it, it's the impact, and also it's how you, what we call, give back. So we've got global, we're called London's Moving University, but we have a lot of leverage in terms of how we impact things globally. So if you were to come to us, for example, or one of our partners, to demonstrate to us that you're worth the backing, socially, financially, and also that you can give something back. I don't know if that helps.
Yeah, that does help. And I'd like to sort of develop on 2 points, perhaps ask Alastair a question and perhaps Ilian. Alastair, we've been taught your business's IP group is very much focused on intellectual property, sort of the clues in the name.
Yeah.
But I'd be interested in your views as to what exactly that is. I mean, I remember the intellectual property was a patent, but it's not a patent, is it? It's much more than that.
Yeah, no, the big philosophical question, I think, but it can be a patent, and actually we look for patents. We work with universities, so typically, we will build businesses around, a patent, or we will try and build a patent portfolio that can be taken through over time. I think probably an interesting angle is it's not always the patent that becomes the valuable piece, so it could be the start, but actually companies build a huge amount of know-how and experience and market information as they go down that road, and often that can be as valuable as the patents themselves. Coming back to sort of your comments, I think the competitive positioning of businesses that go forward is very important, and having a patent or know-how allows you to make sure that you're sustainable over that period of time.
And Ilian, when you were giving your intro about yourself, you said something which is actually quite unusual about venture capitalists, at least in the UK, because venture capitalists in the UK tend to be lawyers or accountants. What they tend not to be is serial entrepreneurs. And does that give you a different view, a different approach to sort of turning the business plan into something that's real?
Well, I suppose it's a barrier to entry in terms of raising more money, but for our fund. But I think in terms of the early stages of investment, it certainly, I think it adds a lot in terms of being able to empathize with the problems that the companies we talk to and the entrepreneurs we talk to face. I think broadly there's kind of a translation element that needs to be done for companies as they go through different stages of investment. If it's an angel backed, if the company is at the angel stage of investment, there is a lot of empathy because many of the angels might have done it themselves before. But as the company grows into the next stage of investment and to talk to institutional investors such as yourselves, or to family offices, or to larger institutional investors, a lot of that empathy kind of has to go away. The business has to go into a different mode, and I suppose we're at that switching point, kind of just after the angels, just before the large institutional investors.
And to what extent do you, as an entrepreneur, or former, clearly, I suppose, to be generous, venture capitalists are entrepreneurs in their own way, but do you get involved in the management, direction, control of the business in terms of its operations?
It's an important question, and it's very difficult to strike the balance. So our bias, not only myself but the other principals, our bias is towards being more involved than what I think is the case with other UK VCs. That's not always welcome, and maybe it's not always productive. So we have to be quite careful, when we switch on the kind of the love and care. But I do think that from our perspective, whether it is us putting our own money or that of our investors, it's all fine and well to say that entrepreneurs need to be allowed to make their own mistakes, but if they're making mistakes on my investors' back and I can see the mistakes they're making, well, I'm sorry, I will get involved and rely on kind of our positive rights than our negative rights, but at the same time, it is possible to have too much attention from investors, and you have to let the company get on with it.
I remember an MD of a company I was in the board of, and he was a very experienced guy, and he said to me, "Peter, I've just got more help than I can possibly need."
Yeah.
And I think that was, that pitch right, actually, he had. Peter, can I ask you a question? Because I was looking at the blurb and about SCP, I remember when it was many years ago that it was Scottish equity partners, and they mostly did speak with a Scottish accent in those far off days.
Diversity policies work.
Do you think there's a difference between a ordinary quotes business and a business operating in the environmental or CleanTech sector? And when you're looking at a business plan, are there any additional metrics or due diligence points that you go through?
I wouldn't say that we treat it any differently. I mean, fundamentally, the business absolutely has to make money. It has to have all the things that we talked about here on the panel. If it doesn't have that, because it ticks a few green boxes, it doesn't necessarily get us through the door or anyone else. And I think these days it's important, and potentially there are other investors that are maybe more geared towards looking for that social responsibility angle. But I'd say that the more mainstream institutional investors are now more focused on, is it actually a good investment?
Do you, I mean, one of the things that always, I recall, you know, maybe I'm going back 10, 15 years now, but you know, in the early days of investing into sort of CleanTech and alternative energy, there was a real concern about the role or risks around government intervention, regulation, pricing. Is that still a view? And I don't know if that's something that...
In certain technologies it is. So I know that the UK had a lot of subsidies for renewable power that were cut quite drastically recently, and I think a few investors did get burned by that. But actually that's quite a narrow part of environmental technology. So actually, from my point of view, we don't even really do much in solar, wind, tidal space. It goes much broader than that. So a lot of it is enabling softwares and IoT and efficiency, and those are actually quite far away from those things. So yes, I think it is an issue for some people, but it doesn't. I don't think it covers the whole industry.
Okay, that's interesting, because I think there was always in the early days of CleanTech environmental investing, there was a genuine perception amongst investors that there was a uniquely high political or regulatory risk around the sector. Is that
the other comment I would add to that is that a lot of these technologies did need the political help to get to where they are, to be able to stand on their own 2 feet, but actually a lot of these industries now are fully fledged and are able to be financially viable without the help. So I do think it is perhaps still an issue in some technologies, but particularly in solar, I think it's reached a point where it's viable on its own.
Do you see that? Because you're slightly further up the sort of utility chain, if you like.
Yeah, so we certainly see the subsidy regime change have a massive impact in the sectors that we look at particularly. So solar has definitely benefited from subsidies, and I don't think we'd have got to the level of cost of energy that we are at now without that subsidy regime to support the industry and to grow. I think wind is suffering a massive impact, particularly some of the smaller scale wind turbines. They're having a big impact on subsidies. Some of the other technologies like anaerobic digestion, some of the clever things around water treatment, they're very much driven by subsidies. So it is definitely a big part of it. I mean, if we were investing in a company in this space, we definitely wouldn't do that unless we're absolutely certain that it could stand on its own 2 feet without subsidies now, because the direction of travel in the UK is very much take everything away and see what happens. And I think maybe in a couple of years' time the government might realise actually they cut it off too early and it might not ever get to that point. But equally, innovation is there that springs up, and who knows what might happen. But subsidies are a big part of this space that we look at, particularly in the UK. It's been a really big part of bedrock of all investment in the space.
Can I, before I feel as I think it would be worth asking the audience the sort of participants, but I'd like to sort of canvass views on one of the bits of the investment process that is often most fraught for both the entrepreneur and the investor, and that's the question of valuation of early stage businesses. You know, there's a school of thought that, you know, early stage businesses are worth diddly squat. They're worth, you know, less than the amount of money you put into them until the first year or so's gone by. I suspect that's a view that the promoters of early stage businesses might not necessarily buy into, but from an investor's point of view, most businesses at an early stage you invest in will either fail or not make a return. You need to bake that into your portfolio calculations. That makes for some very hard decisions. Yeah, I think you wanted to.
Yes, because I feel strongly about it. So it's a problem that obviously all of us face, that there is frequently a big gap between the valuation expectations of good and bad or less good startups and investors on the other side. I think something peculiar to the UK market is that you've got the kind of VC-like or institutional-like market, which prices things in a certain way. And then there is this wonderful, wonderful treasure we have in the UK, which is the EIS investment scheme, which single-handedly has been responsible for plugging the gap in early-stage venture capital since 3i got out of the market in the early 2000s. That's the positive, but the negative aspect is that it has introduced certain valuation sort of phenomena, shall we say. And in the end, it's the entrepreneurs that suffer, because there is this early stage obsession with valuation. I want to get up, I want to control my business and so on and so forth, which is great. Okay, so they get around with a nice up valuation with a bunch of angels that come in. The angels come in, okay, maybe the valuation isn't quite where they would put it if they were putting some real money, but they get the EIS tax break kicker back, and everybody's kind of happy. Company's going up. The next EIS round comes, 30% up. Everybody's happy, but at some point they're going to need money from these guys. And when these guys come in, they're going to come in with a totally different term sheet, with lick prefs and all kinds of other structural stuff that you might want to put whatever valuation you want. It doesn't matter. In the end, the game totally changes. So all of this whole valuation game, all that it's doing is that it's making it difficult for the company to jump between different stages of investment. It is setting the wrong expectations both among early stage investors and the entrepreneurs, and it's setting up the company for a confrontational situation when it comes to serious money, when you get to early stage revenues and doing a Series A and Series B. And I've run out of arguments of how to communicate that both to angel investors and to entrepreneurs, that you need to smoothen out this curve. Nobody benefits from a down round. Nobody benefits from some ridiculous lick pref structure that complicates things down the line. So I think all of us as a community need to educate both entrepreneurs and angel investors about how the whole thing plays out. Maybe you've got the concept.
I was going to ask, have you seen
Sorry,
companies fail from that?
Name?
Sorry, Hugh Thompson from BTL Group. We're a blockchain company. Have you seen companies struggle with that specifically, or is that something
all the time? All the time.
I just want to make a point. I absolutely agree with what you've said. I think the first thing starts with how you value your own organisation and how much you're willing to give in order to get the investment. Some of the issues that we see are that the entrepreneurs think that they can go from 0 to a billion just like that. It doesn't work that way. And therefore they can overvalue the organisation, the company that they are starting. The second thing is, when you are working with people who have the money, there's a balance, there's a power dynamic there, that you have to be very clear about where you sit within those power dynamics. I'm being controversial, but I believe in being honest and upfront. And so when you are thinking about the trajectory of your business, you really do need to think about where you start, how you're going to justify the valuation, and whether you're going to fight for it or not. And what we have found is that we have some businesses who are hell-bent on keeping all of their equity or giving a tiny amount and expecting investors to give them a load of money for something that actually isn't worth very much. And then you have those who have gone a little way down the line in terms of building up the business. And when they get to 3 to 5 years, there's an issue around scalability. And going back to how investments are made, there's a change there. So what I would say to you is, whatever your business is and however you're thinking about it, get some good advice in terms of the kind of steps that you will have to take, and speak to people who have been there. I've set up a number of businesses myself, so I'm also looking at
Oh, sorry. Apologies.
so I never
You can get treatment, you know.
So we understand how these things go. The best advice I think any of us can do is to share with you the experiences we've had, and for you to think about how you're going to relate that. And the other thing I would say is before you go to any investor, be very, very clear about what it is you're offering and have the evidence behind you. The worst thing you can do is go to see an investor and you don't know what you're talking about, because there either you can get taken advantage of or the door will be closed to you.
Can I add?
Yeah, please.
I think sometimes people think that investors want to get the lowest possible valuation, but it's a partnership as well. So actually something that we care a lot about is the relationship we have with the entrepreneurs, and if we put in a low ball offer, we'll just upset them, and we don't want that. So actually it's in our interest to invest at a reasonable valuation. So it's not a case of let go as low as you can and try and get a bargain. It's about trying to pay a fair price for what we think it is.
One more point, I think.
I'll take questions in a few minutes, but I
Short
suspect this
point,
is an
really.
issue on which the panel have some quite strong and possibly interesting views.
Yeah, and I was going to say that not all investors are the same. So particularly in the very, very early stages, it might be hard to find investment, and you might get very high valuation offers. But what you should be really looking for is the long term. The earliest you can get somebody in who's going to not only invest in this round, but in the following round and the following round beyond that, it suddenly makes your valuation discussions much, much easier. And I think everybody would agree that if the management team wants a valuation, it's important to incentivise that management team, and that can always be restructured at each round as the companies develop. So a good investor will never look to sacrifice the team they're investing in for the sake of valuation.
Yeah, I would say it's definitely not a science, it's for sure an art. I think I agree with everything that was said before. At the end of the day, you want to leave with a good relationship with the company that you're backing. So what Lucy said is what she said is absolutely true. I think the worst thing is to squeeze an extra 20% on valuation and leave with a slightly jaded relationship. So we have benchmarks. We get whatever it is, 3,500 ventures in our inbox every year, and we do kind of categorize that and see, let's say it's an e-health business in Eastern Europe. We haven't looked at that, but using a random example, we will look at the average valuation for that kind of company in that certain region. And that's a starting point. At the end of the day, we've gone through this ourselves. We've raised money into Mustard Seed, the holding company, from 6 investors, and there was really no science behind that whatsoever. Maybe just picked a random number, an amount of dilution that we felt comfortable with, and we wanted to get these investors involved, and that was it.
Just a couple other two other points. I agree with all of that, but two other things. Down rounds are terrible for the management team. So going through that really is your chance to lose control of your business. So really try to work on a progressive upward sloping valuation curve is one thing I'd say is really important. And then the other thing, just taking it from a different perspective, fund managers are ultimately there to invest money. So it's in our interest to make sure the valuation is reasonable on both sides, because ultimately we are interested in deploying capital well. So it's not like we're just there to try to take a lowball valuation. It's not necessarily always in our best interest either.
I'll open up to questions, but I would like to come back in a couple of moments and just ask about the panel's views on the impact of crowdfunding, as well as EIS and SEIS on early stage valuations, but that's a slightly different topic. Sorry, you're...
Henry Bolton, I'm a student at LBS, and my question actually was on crowdfunding.
There you are.
So to what extent do you think crowdfunding actually exacerbates those issues with valuation expectations? And as venture capitalists, do you find yourselves being pushed more towards the sort of Series A, Series B lines of funding rather than C? Do you find people are going more down the crowdfunding route in early stage?
Well, we don't see that as either or, to be honest, and we've actually partnered with crowdfunding platforms in a couple of cases, and we like to do more of that. So, for example, we've invested in a company called Beulah, which is an ethical fashion business, and part of that round was filled by Syndicate Room, the crowdfunding platform in Cambridge. We are investors in a company called Mush, which is around connecting mothers who just had babies for the first time, help them deal with loneliness, isolation, postnatal depression. A good part of that round, so we led it. We did a cheesy video that was uploaded, and then Crowdcube filled a good amount of that round as well. So for us, it's not necessarily either or, particularly the consumer-facing businesses where the awareness that's created through a crowdfunding campaign is helpful. We'd definitely be supporters of it.
Any other members of the panel participated in crowdfunding exercises?
Well, some of our startups have, and what we say to them is it's good to have an understanding of what's available in terms of finances, and also in terms of who you want to be involved in your business. And through crowdsourcing, you tend to get people who have similar values or similar outlooks, and so therefore, we encourage our startups to look really broadly around them, and a few of them have been quite successful through that, because through the crowdfunding, what they've seen to get is more of the ownership around what it is they're trying to do. So in terms of the direction of travel, but likewise, we think it's good to understand what's out there and select what's best for your organisation.
Sorry, you got in slightly first. I'll take you next. Sorry.
Picking up on Ilian's
Sorry,
point.
can you?
Oh yeah, so Gerard Greg Smith, I'm a judge and mentor at CleanTech Challenge.
Thank you.
Picking up on Ilian's point about EIS, and now that EIS has actually even overtaken VC in terms of the amount of money it's put in, I was interested in the panel's views on how EIS has contributed. I mean, it's been around a while, but it's actually, I guess, only come up relatively recently, so big. But it's about, the question is about the stage of investing. So people like SCP and ETF it seems to me, are investing later stage. So my question really is about this early stage gap, which arguably is being filled by EIS now. But the question is, why and what's going to happen next?
Who wants to?
I'll have a go actually.
Thank you.
So we acquired a firm called Parkwalk at Christmas time, which was the largest growth EIS fund certainly on the IP commercialisation side. They're raising or deploying about 50 million a year. In terms of where it's going, I think it's becoming more institutionalised. So I think you're going to see more fund structures coming up around the EIS, and they are going to start deploying in a more structured way. I think in the market historically it's been, like you say, a bit of a plug around other people, but it's been extremely useful and it's really generated a huge amount of growth in the market. In terms of sort of the usefulness and the stage of deployment, as those funds get bigger, they're going to deploy larger and larger amounts. But obviously, you're capped at that 5 million level. So there is a limit to which they're going to go into. So round A, tops round B, probably to get a decent holding would be my guess. That's your question.
Yeah, I mean, it was also a bit about the VCs. Are the VCs ever going to come back to early stage like they used to do in the old days?
Just in terms of EIS, the areas that we've seen it, not so much on the venture side, but certainly on the project funding side. So if you look at anaerobic digestion projects in the UK, they've been predominantly funded through EIS or VCT type structures, and they've really plugged the gap there because, frankly, they've taken risks that probably we wouldn't. And I think that's relatively indicative of some of the other situations we've seen money deployed through those structures. So I'd say we're probably not going to cross over too much with them, and if anything, they've slightly muddied the waters in terms of what developers would expect as to what they might consider to be institutional terms on a building contract or an operations and maintenance contract, which aren't really there. VC-wise, I'm not really sure that we cross over too much with those sort of investors, but it's definitely getting institutionalised, and it has a really good opportunity to get better.
I'm not sure if you meant CleanTech in general, or if you meant sort of more general stuff.
More generally.
Because an issue I see in CleanTech specifically is a lot of capital-intensive projects. So it's companies that've got a great idea that yes, it's commercially viable, yes, it's hugely got huge impact, but as a private investor, if someone comes along and says I need 100 million to do this project, but I don't have anything to show that I can do it yet, or I don't have any revenue yet, I mean that's an extreme example, then it's very difficult to do. So I think a lot of people, a lot of investors had a hard time with it in CleanTech specifically, and I think a lot of people moved to slightly later stage to reduce the risk.
I think I've got a kind of a top-down approach on. I've got a bottom-up view in terms of trying to get money into companies, but there's a top-down view on the EIS funds, which is the combination of EIS and taking some tools from the crowdfunding platforms. What it means is that it's kind of democratizing the investment by much smaller investors, in particular IFAs that are investing money on behalf of savers, into fund-like structures. And I think this is the genuinely new thing on the market, because the sort of funds that your own funds get, you know, whether it's from the European Investment Bank and the insurance companies and other LPs, you know, they have fairly large transaction costs, so their minimum investments are 2 or 5 or 10 million pounds, whatever it is. In the context of EIS funds, the minimum ticket sizes are now what, 20k, 50k. I mean, this is genuinely novel in the venture capital industry globally. That you can have you can have private investors going into an institution-like structure with all the bells and whistles and controls and risk management, being able to access these assets. So to answer your question, Gerard, I think in a way it was institutional investors that pulled VCs back out of institutional investors out of the VC market because they couldn't economically invest in that space, and perhaps EIS is enabling the emergence of a new group of investors like yourselves that are able to economically be active in this space again, which is great.
Yeah, I think I'm going to turn to you in a second, but you know, one of the things that it strikes me over the last few years is that the classic 2 and 20 VC fund or model just is not economically viable at a certain stage of investment, and the EIS funds and the other either tax or other policy driven funds have filled that gap, and crowdfunding I think has transformed that. I do think it comes back to there's still a point of the articulation of valuation, because you know it's how you get over that lip, if you like, and I think that's still quite hard, and I think there's a realism on both sides needed. And here in Sustainable Ventures, I think colleagues have done 6 or 7 crowdfunding rounds now, and they've all been successful. And I think if you got Andrew into a darkened room and sort of pressed him on it, he said we've underpriced every one, because down rounds are a disaster for all concerned. So don't do that. And I think there's a lot to be learned by practitioners and entrepreneurs about how those valuation points are managed, those transition points from one class of funding into another, so that you don't have a step that people trip over. Sorry, you've been desperate to ask.
So that's right. I'll just lead on from everything you said. I want to reframe the crowdfunding question a little bit.
Sorry, can I ask before you?
You can. Let me just get to that. So
Sorry.
My name is Stewart, and I'm from a semi-corporate finance. I'm listening to speak to you today. You need to laugh. So one of the tedious things we do in our job is we track every single venture investment done in the UK, and we've done it for 20 years on crowdfunding. Crowdfunding now constitutes, in terms of technology, about 11% of all, in terms of volume, of all technology funding is done in the UK. So that's, in the last 3 years, it's gone from 0, so 2013, to now to 11%. That's pure number. Sounds great. It sounds great until you look at the average deal size, and then it all gets old. Yeah. Then there's the really nasty question, and that's the one I'm going to ask the panel, because that's why you're experts, so I'm just a humble, slow-witted corporate financier. What is the panel's view on how feasible it is for companies who raise a crowdfunding round to raise the next round from a VC? Because I know what the answer is to that, but the data. I'm just intrigued to know what you think the right answer to that question. Because fundamentally, if there's people in the audience who are thinking about raising crowd now just to give them 200k, 500k, if you're really funky dudes, you might be doing one or a little bit more than one. But can you go out and raise 2 million next year from a VC? And there is the right answer, but I'm interested to learn what the Connor thinks.
Who wants to walk into that elephant?
And I'm happy to give the answer afterwards, but just let's see what they say.
Do we have a volunteer for sacrifice?
If he gives the answer first. I can go first. A volunteer. I mean, it's potentially a poison pill. I think what's really important in crowdfunding situations is that there is a decent lead investor that's not crowdfunding, and that decent lead investor is genuinely third party independent and is putting a big chunk of money. It's basic economics. You know, if you're putting in 5, 10, 20k into a business that's raising $1 million or $500,000, you know, you don't have the economic incentives to do any due diligence. It's a bet. It's a bet. So, you know, who did the due diligence? It's basic economics. There's a fundamental information asymmetry. There's a moral hazard in this situation. So somebody must have done the due diligence. That's the reason why financial intermediaries exist. So I think, so that's one aspect. So if there was a lead investor that has led the round, set the terms, and then others piggybacked on that, okay, that really decreases the risks for follow-on investment. The second aspect, and there is no right and wrong answer, I think some intermediaries are starting to fix that, but it's if you end up with a shareholding list that's like the electoral roll, that's difficult to manage, so it might just scare away some institutional investors if that isn't consolidated with some sort of mandate for somebody to vote on behalf of the other shareholders. But you've had an experience with that.
Well, we haven't invested in companies that have previously crowdfunded themselves. We've co-invested with a crowdfunding platform. We have been the lead investor. And we're too young in this, so we've only been doing this for 2 years. But I wouldn't say we definitely consider investing in businesses that have previously been crowdfunded, but I totally agree with what Iliev said. You'd want to have had a lead investor in that prior round. And it wouldn't need to necessarily have been a VC fund. I think for us, if it was a very credible angel investor that had done his or her own homework and diligence and was putting in 50k plus, that would be equivalently meaningful than having a fund. We definitely consider it. And then I think there's sort of working with a really good crowdfunding platform versus anyone that's in the street, and I won't mention specific names, but you know, I think everyone knows which are the better ones that are out there and which have a track record of success in the industry.
I'm guessing here because we don't really see any that have come out of crowdfunding, so the companies we tend to invest in are more B2B, and it's sometimes hard to articulate that on a crowdfunding platform. You know, if you put on a crowdfunding platform, you've created an integration software for smart meters, then people aren't going to jump around about it. But if I were to make a guess, I would say that people can take crowdfunding, and the criteria to raise money is very different to what a private investor would be. So is this exciting? Do I think it's cool? And it's probably assessed on very different criteria. And actually, perhaps a company that wouldn't have raised money otherwise is actually raising money. And then the fact that they don't get follow-on investment is perhaps nothing to do with the fact that they've had crowdfunding, but to do with the fact that they perhaps wouldn't have got funding in the first place without it. That's a guess, and I can tell by your tone that the answer is that they don't get follow-on investment. So that would be that's a stab in the dark that may be something to do with it. Because the other comment I'd make is starting out in this industry, I've been surprised at how forgiving investors can be of all sorts. Because if we find a company that we like and it's people we like, and we can see a way around the issues, we can forgive a lot as well. So actually, if we did come across a company that had been crowdfunded, personally, I don't think that would put us off. But we would do our usual due diligence and look for different things.
The only thing I would add, and it's absolutely in agreement with what everyone said, for us, the main obstacle would be the equity share that's available, and that's covered under the due diligence. Now, crowdsourcing is a good way to get money if nobody else will touch you, for example. However, I think because it is still so new, what people need to be thinking about is when they get to a particular stage, how are they going to be able to identify who owns what and what actually they can raise money with.
Shall I ask another tricky question for just to make
No, I just want no. You have to give us the answer before you ask another question.
Just to make it, because we're almost about speculation. Last year there was 629 investors who invested in a deal of more than $500,000 in the UK. 629. How many do you think invested in a follow-on round, a crowdfunding round? 629 investors who did more than $500,000 in a deal. How many actually put money as a follow-on round?
So $500,000 in the aggregate size of the deal?
No, just the minimum size of the deal.
Okay. But the minimum, not the minimum ticket size, the aggregate size of the transaction.
That's right, yeah.
Okay.
So how many out of those 629 investors actually did a follow-on round? Of course, you know where I'm coming with this. So let's make it easy for you. Was it less than 10, less than 20, or more than 20? A, B, or C?
I think the question you're asking is slightly unfair because there's a number of different criteria.
It's
that
something
would
you want
be
to kind of
used
What about funny? You can't get the old easy question. He's asking me the easy question.
That's my job, asking easy questions.
So does anyone want to guess just for fun? 'Cause I'll take the
My money's on B.
C.
I think about 10.
My money's on just one.
No, it's more. So the answer is in fact D, which is more than 10 but less than 20. And most of them have actually been, as you probably expect, the guys who have invested in the crowdfunding platforms like Index, IQ, Index, Draper, all these guys. And well, good one, I must have seen.
Okay.
Also,
Now, I'm going to move on, but before I move on, you haven't given us the real answer to your first question.
you're lunatics if you get a high capital intensive business, which most CleanTech businesses are, raising money from a crowd platform is suicide.
I agree with that. Now, I'll take two questions now, and then I'm going to move on, once we've had that discussion, to one of my favourite subjects, which is exits and liquidity events. But sorry, you had your question up, just before you, so...
Hopefully this is a slightly easier one. My name's Jack Shipman, and until yesterday morning I was a banker with Credit Suisse.
Congratulations.
So, I guess I'm just curious about, given that you'll have an extremely broad universe of potential investments you could be making, how do you go about prioritising the capital you deploy and the time you have if you're a small team? I guess I'm thinking kind of like Mustard Seed's case where you have, you're trying to achieve impact, like how you go about measuring that and prioritising your investments.
Yeah, so we're a team of 5 full-time and then 2 part-time, so quite a small team based at Wara, and I think 3,500 is about the volume of flow that we get in our inbox, which comes from referrals, university relationships. We've done a lot of these events at top universities, and then submissions to our website. I guess the first quick filter is does it fit the areas we look at: health, education, environment, family, economic inclusion. Gets to about 700 or 800 a year, and we probably meet half of those, one a day on average. Our team members will have the initial meetings, and that's just a judgment call. Someone has to grab it. If it comes from a trusted referral, that makes a big difference. And then it's very consensus based, and we'll discuss probably half of those in the weekly team meetings and come out. And there's a longer version of obviously what I'm saying, but we'll end up with 8 to 10 that we decide to back, where there's a social mission that's big and quantifiable that we can define clearly, measure and track, and all the things I said before about the founders and so on. So we have to say no to almost everyone, and saying no the right way is really important for us.
I think the answer to that from our perspective is through partnerships and collaborations, because we, in the entrepreneurship team, we're quite small. However, in terms of the reach and the people that we work with, it's broad, and it's utilising their tacit knowledge, their experience of how they measure certain things. It's looking at key drivers, so what are the governmental drivers, what are the societal drivers, what are our own drivers, and looking at what can happen in the future, so scenario planning. And it's those kind of things that we use in order to make our decisions. But it goes back also to what I said before. It's about if there's something that we think has potential, we're actually meeting with the people who are involved in it to see whether they have the real passion for the idea, whether they have done the due diligence, whether they have the resilience when things go wrong to actually move forward, and whether they can convince you that not only is the business sustainable, but they have the credibility to take it to where it needs to get to, with your support, of course.
Alastair, can I go back to the intellectual property point on deal selection? I mean, how does that play in?
No, it's very important, and for us, we do a huge amount of work around those patents and that patent portfolio. So we will hire patent attorneys to give a view, and they'll look at all the other sort of intellectual property around that, and we'll take a view as to whether that's protected enough for what we do. It's important.
But a lot differs. I mean, if we're talking broadly about environmental technologies and so on, a lot differs on the kind of technology horizontal, if you will, that you're looking at. If it's a material science deal, patents are extremely important. Probably the patents will outlive the team. Probably the team will change a few times before the business is successful, unfortunately. Yeah. But if you're looking at the IoT deal or software services platform, okay, it's nice to have 1 or 2 patent filings in the US as a signal to the next round investors, but it is very, very unlikely that they'll ever come to defend those patents. The industry will move on by the time those patents are granted. So you have to keep in mind what technology area you're looking at.
Yeah, so we're a little bit specialised.
And
So we do that side of
specialised,
things,
yes.
which is good. But actually, it's what I said earlier about know-how. So even in the IP side, businesses will develop, software algorithms or whatever they need, and actually, having that know-how and that whatever it is, 2 years of lead time can be just as beneficial. I think.
Can I contradict myself?
Of course.
At the same time, there's industries that you look at them right now and there's no patent litigation whatsoever. It's super stable. For instance, the automotive industry. Until a few years ago, the automotive industry was the most boring industry in the world you can imagine. And then something happens, some shift happens, whether it's Tesla that comes in or somebody sues Toyota for its Prius hybrid engine. And then there is a flip in the industry and all of a sudden it becomes extremely litigious. Same was the case in the telecoms industry. It was a very, very quiet industry. You had the ETSI telecom standard thing. Everybody were pulling their IP in there. Not that patents weren't important, but AT&T had a bunch of patents and Nokia had a bunch of patents. They're all pulling it into the standard. And then something horrible happens, such as smartphones, and then people start suing each other. So on the one hand, there's what I said. On the other hand, people go into an industry that's very quiet and patents don't matter, and why should we waste money in this space?
Because they're bloody expensive.
They are very expensive.
Yeah.
And then something happens in that industry that patents all of a sudden become extremely important because the entrepreneurs turned out to be right. It's a big space that's being massively disrupted, and there's these big tectonic plates shifting around the continents. So I have no answer.
I agree.
Stewart, I promise you next.
Stewart Nicol, been involved a bit in crowdfunding, pleased to be an equity punk and brewdog. But my question is actually around local government. I'm doing some consulting work with Exeter City Futures at the moment, which is basically a commercial kick trying to get local government to reconsider how the whole of the city works. I'm just curious if maybe 3 things you think either local government you're aware of is already doing to help your investees, or maybe things they ought to be doing.
So, did you want to go? Okay. So in terms of the entrepreneurship space, every local authority has a duty to support the development of employment within their area, and they do it in different ways. So it could be looking at the impact they have locally and then linking it up to the regional strategy. So for example, in London you've got Leap, who are under the mayor, who are looking at how to support entrepreneurship activity, and then it's gone all down through the devolution to the individual authorities. So what they tend to do is to provide advice, co-working space, bringing people from different industry to provide mentoring. It's the kind of thing that they do. In terms of the investment side of it, they will link with a few fintech companies and a few financial companies to bring in that advice. I think what they could be doing more of is thinking about helping entrepreneurs review how they access that funding, because a lot of what local governments provide is very heavily regulated. They need to be able to report back on the impact that they've had, how many businesses they've supported, and that doesn't necessarily look into the sustainability or the value of the actual business or the entrepreneurs.
Sure, can I step in there? Because about 10 years ago now, I was involved in setting up an organisation called Capital for Enterprise, which is one of the precursor bodies of British Business Bank, or Bank of Vince. And one of the guys on the board of that was a fellow called John McCrory. And John, back in the day, managed the unlisted investment component of West Midlands Pension Fund. And he was one of the first and biggest investors in unlisted equity for any UK institution or sort of pension fund institution. I think he was in Apax One and Sequoia One and all of those wonderful things, and he did personally very well. He's a very, very shrewd guy. But I suspect behind what your question might be that local authority pension funds are very large pools of available capital for investors. I mean, they've got, I don't know how much money they've got under management, but it's a lot. And there's been, over the years, a number of policy attempts to direct those pools of money into whether local investment or whatever. I think my sense is that they've universally disappointed. I think pension funds who have sensibly made allocations into alternative assets, the way that any endowment or welcome trust has done, have been very successful. But local government or local authority organisations stepping into a policy field, I think has perhaps had a less happy track record.
I was actually thinking, I think you're right, but I was thinking more around the investee level. If you think of a circular economy business, an aerobic digestion plant, all these things needs local assistance, and we need it quite soon, otherwise we just run out of money. And it seems to me that the local government mostly just isn't wired that way. So you don't have the innovation that ought to happen, and you don't make investments because the local government isn't wired that way. It just seems a bit mental.
But there's also a big problem there in that the local authority, the council, might really want an anaerobic digestion plant, but then the planning authority, whilst it's still part of the council, is a separate body and it just decides no. So that's the piece that's really disjointed in this country that's frustrating that sort of innovation as well. You need to have that sort of policy shift to make that happen.
I mean, at least in our portfolio, we've got at least one example where it's actually worked in our favor. We invest in a great company called Qbot, which is robotics in the beauty industry. And what they do is they do underfloor. They spray underfloor insulation for old Victorian houses. Just I could never imagine this market existed before I came to England. But there, what the company combined was, well, first of all, there's a huge problem there. There is money to be had, but also they actually create local employment. They unemploy people and skill them up to work with robots. So in this case, actually working with local housing authorities worked really well for Qbot in terms of building a market that larger corporates cannot access. It's too fiddly for them to get in. So.
Okay, I think, sorry, I'll take one question because we're sort of running out of time and we haven't touched on...
What do you think then, building on that question, the role as a goal set by the government, so be it environmental, be it how much needs to be spent on innovation, because local governments also set these short-term goals. Is that then how these smaller industries actually invest for itself?
Well, I think the government needs to be consistent about those goals.
Good luck with that.
That's the challenge that we've seen in the environmental space. They haven't been consistent. If you could see that, I mean, carbon, for example, pricing carbon has been something that's been yo-yoed in this country a lot. And if they stuck to the policy and kept with it, that would allow markets to develop around saving it properly. And that's where the government can actually set proper policy on a top-down basis.
I think we're running slightly short of time. Sorry, I'll give you a question. Sorry.
Yeah. Sorry.
Take a quick question, because then we'll have one more topic and then we'll quickly wind up. Sorry.
So, 10, 12 years ago, offering 6 to 12 times cash to cash sounded like a fairly interesting prospect. And over the last, my Adam Davis Entrepreneurship program at the University of Oxford. What we seem to have found is that rather than perhaps blaming their own investment decisions, that people are spreading their risk, or investors are spreading their risk now, so that we're hearing high-end angels and VCs coming in looking for people who can, rather than build very good businesses, build very good spreadsheets. So they are asking for 20, 30, 35, 40 times cash to cash. Where do we see the market going? There's sort of a big elephant in the room on the valuation question in terms of what investors are now looking for. What do we see this number getting higher and higher and higher, or do we see maybe a return to sort of the mid-2000s where 8, 12, low risk, but sensible return companies are actually going to be attractive to the VCs again?
Can I wrap my final question into that as well? Because my final question was going to be, when you write that wonderful paragraph on your investment paper, which was always used to be investment with point 11 on our paper standard structures, was exit. How do you think you're going to get your money back, your investors' money back, and what sort of returns do you think you're going to get? Or do you? Or I'm sorry, rephrase that. What sort of returns do you tell your investment committee you're going to get?
I'll start.
Yeah,
I can
please
say
start.
the easy points first, then pass it on. So, as probably many of you know, if you've got a fund, you've got risk in each company, and by investing in a number of different companies, you obviously reduce the overall risk. But there's no point in investing in a company and taking that risk if there's a cap on that return that's quite low. So even if a company looks good and looks quite low risk, but is only going to give us a 2-3 times return, and it's kind of capped at that for whatever reason, then that's something that's unattractive to us. It's a very basic comment, but.
But you're not only looking for unicorns.
No, that's true.
Okay.
Yeah.
Is there a magic number?
Not that I would. No, obviously we want it to be as high as possible. I think the biggest thing is not capped, because actually the situation quite often, especially if it's a later stage company, is unlikely to go above a certain number, and that is not good, because it's such high risk. You can't take a high risk and say, oh, best outcome is 3 times my money. That for me is probably the biggest input I can have.
Good
For us, it's a combination of things. So there are businesses that we support that we will call safe to fail, because we're giving them the space to see where they can go, and some of them, just by getting that small bit of investment, will just scale up. The real business side of it is covered by UCL Business, who are you probably would know, are the ones who look at the IP, they look at the risk, they look at the potential of the income, and decide, is it something that we can invest in because we can get some money back. I hasten to say, we don't grab a lot of IP, and we don't grab a lot of the equity, but it has to be something that seems fairly big for UCL Business to invest in. So all I would say is that we look at risk in a different way, because we exist to support ecosystems and to support the development of startups through our businesses, and also through the local ecosystem in London as well. So what I would say on behalf of the organisation I work with will be different from what everybody else would say.
IP group.
Yeah, well, I mean, we're not a typical VC, so we invest for, our average holding period is 10 years plus. We have companies that we've been in since the start, since 2001, and we will continue to invest in those businesses over the long run. I think looking at returns, I think it's more about the ethos of that business and investing in something that is genuinely novel, genuinely game-changing, and can be deployed into changing a large market. And if you get those things right and you can fund it all the way through to commercialization, then you're going to make money. There are obviously decisions on the way. I think the other thing that we do is we haven't talked about it tonight, but we use AIM quite a lot. So we will put companies probably a bit earlier than they would do typically onto the public markets, and that allows us to bring in other investors that can follow their money again for that long-term duration. I think that's particularly key for very R&D heavy businesses to be successful.
I mean, we're not yet managing a fund, so probably my answer will be different next year, but at the moment we have the benefit of being quite flexible and pragmatic on a deal-by-deal basis. If it's a seed stage investment, yeah, of course, we have to put crazy return numbers if this were ever to be successful, sort of stuff. If it's a later stage business, with revenues and so on, then you see what you're dealing with and you have some visibility on the exit. I think where we are trying to kind of shape our destiny a bit more is by really looking to partner with large corporates a lot. It probably means that it's less likely we'll come across a unicorn, kind of Old Street style unicorn, but we think that limits our downside quite a bit. It increases the survival rate of the companies we back, and probably also it increases the speed of them getting to market and deploying their technologies. It puts certain limits in terms of what the company can and cannot do if they're working with corporates rather than going direct to market. So it's not B2C sort of stuff. But we feel it really de-risks the propositions that we back.
I mean, we're sort of learning as we're going, to be honest. We started 2 years ago full time. The first company Henry, my co-founder, and I invested in was a business called LifeCake. We actually met them at the first pitch competition we did at LBS, and we both invested £20,000, and that was bought by Canon 6 months later. And I think we probably had a surreal expectation of what the reality was like. And since then, since we've been kind of full-time on Mustard Seed, we've invested 11 times in different businesses. And probably could or should think more explicitly about exit scenarios. We think about the commercial model and how we can help that commercial trajectory in each case through our network usually. And sort of thinking that by making those introductions, one of those commercial partners would be a logical buyer of that business. So in the case of Winnow Solutions, for example, that's reducing food waste in commercial kitchens, we've made lots of effective introductions, and they've got commercial contracts through those with Compass Group and Sodexo. They would be logical buyers of that business, but we don't think about it in that lens really. So maybe we should think more explicitly about it.
SEP is definitely more on the growth capital stage now. So typically we don't invest until it's post-revenue around 5 million plus. So in terms of exit valuations and exit multiples, that's very, very difficult to say. I think what I would say is that we're very much placing more of a premium on certainty of delivery. So you might take a 2 or 3x over 10x because that 2 or 3 is definitely going to land versus the 10. So there's definitely a trade-off now. Once your fund's a bit more mature and you have to fund 8, I think. So that's very much that sort of mindset now, is to focus on delivery.
Can I ask just one small point to that? We're at the peak of the market right now. Next year is when it all starts to. So what happens right now is you have, as you've seen across the panel, all those people who have specific, non-stated, vague, and things they can't mention about returns. Everyone's got different investment returns depending on what your investment strategies are. Those will all harden very quickly in the next 2 years. They will all narrow down possibly to the 2005-600 return. But right now, everyone's all over the place. If you compare it to someone like Notion Capital, Founders Factory, Index, and those returns compared to other folks who've got a more social mission, they're all over the place. So there is no formula right now.
I think we need to wind it up. I'll certainly find that an incredibly interesting and enjoyable session. I hope the panel has found it enjoyable, and I hope you guys have found it enjoyable. I think we've got about another half hour to drink the beer and eat the food and talk to each other. So thank you, and if you could show your appreciation to the panel in
Just a quick announcement. So we're going to break out for a very informal session to network around with the panel. Just stick around for a little bit more so that you can ask any sort of questions that you guys have over some beers, drinks, and some food. Before we do so, we have a special catering for today for the food. Sophie runs her own startup on the food side. So I'll let her give you just a 1 minute, 2 minute pitch about what she does and the sort of food that you'll have with us.
Thank you very much. So I launched a company last year, about 8 months ago. It's called Ilian, and I make breakfast and canapés with rescued food from small producers. So rescued food is a food that would have been wasted, and I select it among local producers in the UK, such as cheese or bread, and all high quality food, but with some imperfection. So for instance, you may have heard of ugly fruits or ugly vegetables, but there are also cheeses with a hole, or broken crisp bread, or bread, misshapen bread, for instance. So I buy this from local producers, prepare breakfast, aperitif, and deliver by bicycle to offices. So if you have any questions, please let me know.
And you have business cards to hand out?
I do.
Good.